Welcome to Coaching and Coffee. This is our second session with myself, Tim Smith, and Ray Brown. We've got a few guests here today. I'm going to hand over to Ray quickly just to take you through the subject of the day, but it's very exciting and we're always keen to talk about finance.
All right. So this is our standard diagram that we look at when we speak about improving an architectural practice. And in order of importance, we've got to get the practice itself right. Then we've got the projects. Then we've got the people. And of course, in the middle, we've got the perceptions, all the sales and marketing stuff that we do. So today we've decided that we're going to focus on the practice and we're going to focus on one thing in particular. But this is an open discussion. So Nick and David, particularly, would love you to join in and just give us a little bit of feedback as to how these are going and how we can get most value for you. So today's about the practice, and the topic that Tim and I thought we'd speak about, and the place we get a lot of, it can be confusion around even the simplicity of the words, is the difference between budget and forecast. And why do we need a budget and what is a forecast and all those things. So maybe, Tim, if you start off with what is a budget, and maybe we can chip in as to why we need it and the impact that we see budgeting having on the clients that we meet.
Yeah, okay, thank you. I'm sure I'm going to describe it differently to how you would describe it, Ray, unfortunately. It seems like there's many ways of doing it. But a budget really is a set of numbers or a financial plan for a certain period of time. I'm in Melbourne, Australia, and our financial year runs from July through to June. Obviously, in the US, I think most of you are on a calendar year from January through to December. And I think New Zealand's different as well. Maybe March, your financial year starts in March. But we plan our budget. Ideally, we've done our vision first. It's a really good idea to know where the practice is heading, and you've got some direction for the business. And then your budget can become the 1 year or the first year, the financial articulation of your vision. So that's a really great place to start in terms of, broadly speaking, how much money does the business want to earn? What's our ideal profit, and what are our expenses look like? And so those are the three key numbers that underpin our budget: total income, total expenses, and this desired profit. So that's the essence of it, really, in terms of we do it because it stems from our vision. It gives us a financial plan for the year and sort of a broader goals to hit, and we can break it down in terms of monthly targets. So we've got a plan for 12 months. We know what we need to hit in terms of revenue. We can monitor our expenses throughout the year, and we can actually make that budget a reality by working towards it incrementally throughout the months.
Perfect. That's a good introduction. I think to me, the budget is the link between the past and the future to some extent. And so the profit and loss is a record of income and expenditure over a period of time. That's the profit and loss. So if you're looking at last year's P&L or profit and loss you might get from your accountant or out of your accounting system, it'll tell you how much revenue you've got and how much expenses you've got and what profit is left over. And the idea of the budget is to look forward and say, based on what we now know and all the information that we've got about our business and where we're heading, what does the next 12 months look like? And breaking that down, and a budget allows us to do a lot of things. It's effectively our scorecard. If everything goes really well, this is what the next year is going to look like. This is how much revenue we're going to bring in. This is where we're going to spend our money, broken down by all the different expense categories. This is the profit that's going to be left over. And we can tell you right on day one, the budget is going to be wrong. Okay, it's not about accuracy. It's about preparing something that we can look back on and say where we got it right, where we got it wrong. So the first thing to remember about budgets is that it contains numbers, but it also contains words as well. Okay, so there are a list of assumptions in your budget. Where did you come up with these numbers for? Where did the numbers come from? And So there may be, we're going to pick up one client of this type every couple of months. We're going to spend this on salaries, takes into account that we've got a new person starting in March and we predict somebody else starting a little bit later. So we can build all of those assumptions that we've got in words into the budget itself. And then what we can then do is on a monthly basis, typically our accounting system will spit that out for us. We create the budget, we upload that to our accounting system, and each month it'll produce a report that says, here's what you said you would do, and here's what you've actually done. And that's where the value starts to creep in. So maybe Tim, if you could speak about the how we use the budget in terms of our monthly reporting, particularly the what we call the budget variance report.
Okay. I think so. Lots of our clients in the sort of this part of the world use an accounting software called Xero, but I know globally a lot of people use QuickBooks as well, and there's others like MYOB and other sort of software products. Monograph are also sort of creeping into that space with their project management tool. But they all do the same thing essentially, and they from your accounting tool you can download your own personalized budget template, which is a really great place to start, and that will be bespoke to your business, and it'll have all your own account codes. And ideally, if you've ever look at your P&L, it should look relatively familiar. So you download it from Xero or from QuickBooks. QuickBooks, I think, is a live platform where you input the numbers online into the budget, whereas with Xero, you download it, you populate your budget, and you upload it back into the software. And then that enables you to run this, which is a really simple but fantastic report, the profit and loss budget variance report. So you have your budgeted numbers for 12 months and you run the report each month, and it compares, you finish your invoicing, you reconcile your accounting software, and then you download the report, the P&L budget variance report, and it will show you a comparison of what happened in that month against what you had budgeted. So you can see whether you've hit your sales targets. You can check your cost of sales, and you can run your eye over all your expenses in terms of, did I pay the salaries? Hopefully, did I pay my rent twice? Is everything else there? What are the anomalies? And it's not about things being right or wrong. It's just about knowing what has gone on in the business and being really, I guess, up to speed and across what is happening as far as the practice is concerned. And obviously, ideally, you're making 10, 15 or 20% profit. And doing this on a monthly basis is just, there's a book called Traction, which talks about objectives and goals and breaking things down into rocks. And I think having a vision and then a budget for a year and then breaking it down into these monthly chunks. And then we see it time and time again. When you hit your monthly targets, it's incredible how close you can get to those budget targets, after 12 months, literally within, 1 or 2 percentage points. So that monthly practice and doing this process and making sure those, you are hitting the mark, absolutely pays dividends over 12 months.
Yep. And just on that budget variance, of course, typically we encourage people to do the current month. So what's happened the month that's just passed, and then the year to date alongside that. So it's one A4 sheet, and the year to date will sometimes smooth out some of the, if you've paid a big bill in 1 month, you might look at that, but then over the period of 5 or 6 months, that's flattened out and you're back on budget again. So you could be out on the budget in 1 month, but in line year to date. So it's important to look at budgeting from those two perspectives, current and year to date. So Nick, just maybe tell us a little bit about your practice and where you're at, and do you use a budget at the minute, or is that something you are thinking about?
So about, I don't know, a year ago, I pretty much quit architecture because I was over it. And I've been, before that, so I started my own company, and then we had 4 staff, and then I sold it to a building company because I was kind of over it. And then I went and worked for them. They paid me heaps, looked after me. And then I got over it at the start or end of last year. So this year I've just been playing around with different ways that I can help other designers and architects. And at the same time, kind of planning and plotting how I want to go back into architecture.
Okay, great. So
Mm.
budget is probably a good idea to even if your practice is still embryonic and you're thinking about it, uh, doing a budget for this theoretical business that you're going to set up is a really, really good exercise. And I know, David, you're kind of back at the beginning as well. So is the budgeting conversation something you've been thinking about?
Yeah, it's been more about how many studies I'd like to do a month, and I know what each of those would bring in. So I have a general idea of um, what I'd like to bring in. Um, one as you were talking about this, one question I had was, if you see month after month you're not quite hitting or things aren't meeting your budget, do you ever mid-year kind of set a new trajectory or kind of course correct your budget as opposed to if you can't seem to get your numbers to get where you want them, or is
Great
that something
question.
you just kind of do at a
No,
yearly point?
I think I'll send you the $20 afterwards for getting that segue so well done between budgeting and forecasting. So if typically what accountants do, they will halfway through the year, so you're miles out from your budget. It's a pointless exercise now. Let's rebudget and we'll bring everything back in line. And we say no, don't do that because you're going to lose all of those assumptions. If you're a mile out, you need to know why you're a mile out. And if you're a mile out halfway through the year, you might be able to bring it back into line by the end of the year, but maybe not. Irrespective, the original budget and what actually happened is an interesting story in itself. But what you're actually speaking about is forecasting. So if we move on to forecasting as a topic, what an accountant will do to give you a forecast is they'll take actual year to date, all the months, add those up, and then they'll put the budget in for the rest of the year, and they'll say, there's your forecast. Okay? Actual plus budget equals forecast. We completely disagree with that because if you're halfway through the year, you will know things now that you didn't know at the beginning of the year. And it's stupid not to take them into account and rely on your original thinking from 6 months ago when you did the budget. So what we say is that, fill in the numbers actual year to date. Then for the balance of the year, you need to include everything that you now know. You've picked up a lot of contracts, you've lost a lot of contracts, things are going well, things are going badly. You need, let's say you're halfway through the year, for the rest of the last 6 months, you need now to put in what you think your expenses are going to be based on current experience and what your sales are going to be based on recent experience. And I'll get Tim to explain to you the importance of what we call work secured and work still to be secured, which comes up when we start doing a forecast. And it actually puts architects in a very favourable position because typically you've got work that you've signed up already, so you know how that's going to be phased over the last few months or the next few months. You know what your expenses are running at. So there's a calculation to be done there in terms of you can get a fairly accurate forecast. Unlike if you're in retail, you don't know who's going to come in the shop tomorrow. Things can happen and affect the trade. But in a retail business, you're still expected to produce a forecast. If you run a big department store, your board would expect you to come to a board meeting saying the next quarter is looking like this. And that's based on all sorts of things. But I'll let Tim explain to you the difference between work already secured and work still to be secured.
So, as Ray mentioned, the work you have secured. So you have a number of projects in the studio, whether it's half a dozen or 10 or 20 projects. And when those projects you are called your work you have secured or your work under contract. And typically, what we encourage architects to do is to plan out that work over the subsequent months. So you're going to work on those various projects, at different at a different pace based on where they're at in terms of the project cycle. But you map that work out. We have a project planning template that we use, but other people, have other ways and means, and software tools also do a pretty good job of that. But it's a really important and often a missing component of a practice where people are busily working on a whole bunch of things and there's no real structure to what's being worked on. The noisy client gets the most priority, or the biggest project might get the most priority. But it's a really great idea to map out that work, and that plan to do the work in the studio, that's your work you have secured, and that's the top line of your forecasting document in terms of how much work you will get done this month and next month and the month after. Sometimes that plan can be 6, 8, or 12 months deep. Then the balance, and that will be those numbers will be high to begin with, and will taper off as that work you have under contract slowly you work through it, and it slowly dissipates or drops off. And then you basically supplement that, I guess, with the new work you need to bring in. So this is the work still to be secured or new business. So in order to meet those, either the budget targets or the capacity you have within the studio, knowing how much your team can get through and how much work is comfortable or achievable, that's the work you still need to find and secure in the firm. And so together, those two numbers, the work you already have and the work that you need to win, will make up those monthly targets of your forecast over the next sort of 6 or 12 months.
Yep, perfect. And those forecasts taken together with the actual months that have gone before will give you a new projected full year revenue target. You do the same with the expenses. Are we overspending, underspending? Is the total expenses higher than we expected or less? You would take that into account. So now you've got the sales expenses, and that will give you a projected profit, which hopefully is better than you budgeted, but maybe less than you budgeted, in which case you've got two options. You can either cut costs or look to win additional work. And architects are always looking for work, and as technical people, sometimes this whole concept of forecasting can become a little bit problematic. And I do have one client, and they keep telling me, well, it's impossible to forecast. We don't know what's going to come in the door, da 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 da. And I've told them that there are a whole number of things that you need to take into account with your forecast. So the first thing is capacity. If you've got capacity to do $30,000 worth of work per month, why would you forecast less than that without taking action? So the capacity is number one. Number two for me would be the state of the market. Are you getting lots of leads, or have the leads dried up? Just a feel for where the market is at the moment. Third thing would be, how many live proposals have you got out there? How much money is waiting for somebody to decide to go ahead or not? And you've got a historical focus on what's your conversion rate between the number of proposals you put out and the number that you win. So it may be 1 in 2 or 1 in 3, in which case you need 3 times the number of proposals to get a solid number to put in the forecast. And there are other factors as well. Just how the business is feeling, holidays coming up, available skills that you've got within the practice. So whilst you might say, well, it's really difficult to forecast because it's just a bit of a suck it and see type number, it really isn't. And it is part of your role as the leader of a business, whether it's really small or really big, is to know where you're heading and what that kind of looks like. Yep. So that
it is a fantastic document, though. I mean, we encourage people to do the budget. We were talking about earlier at the beginning of the financial year, and to David's earlier question, it's not a set and forget, but it's certainly a set and don't rejiggle. Just that's the budget we had, and those are the assumptions we made, and this is the financial plan for the year, and we're going to work month on month towards that to try and achieve it. Whereas the forecast document really enables us to change things on certainly a monthly, but almost a weekly basis in terms of work we're winning, things that are changing within the practice, and it keeps a really great, it's accurate in terms of what has happened, and then the forecast, because we're tweaking it, every month, it's really a great projection in terms of where we're going to end up, and it's a powerful document, and probably the favorite for clients in terms of, that gives them real confidence around what's happening in the practice or in the business, and what the future looks like.
And we're very fortunate to have a budget expert with us in Kate, who's just joined us. And Kate has been you've done 2 of our programs, I think. Is that one of our programs?
Just one.
Just the one. So
the recent one, yeah.
The recent one, that's right. So tell, maybe if you don't mind, a little bit about your practice and where you're at, and where does budgeting fit into your story if you do it?
Well, I learned a lot about budgeting for the course that we just did. But I have a small practice and there's 3 of us. And I think the thing I've been struggling with the most is, sort of not being able to control it. But I think these things that you were just talking about are what I'm starting to realize, that there are some things that we can control and understand. But I think I've gone through just my probably last 2 years have gone from being really too busy and not being able to manage it to flipping to the opposite quite quickly. And so I'm trying to manage how to get a little bit more consistency, because it seems like it's a bit of a up and down. And my 2026, I'd like to just sort of be consistent. So that's what I'm trying to work through at the moment.
Okay, perfect. So maybe to put the budget and forecast into context of what we recommend for clients. So a bit like the practice projects and people having a little bit of a hierarchy in how you get this right. I think the financials are the same. And number one is the profit and loss account. So if you're not doing a profit and loss monthly and you're waiting, or keeping an eye on the bank account, or you're waiting for your accountant to tell you what you're doing, or how well you're doing, that's a mistake. I don't care how small your business is, on a monthly basis, you should be looking at the profit and loss. The next bit of sophistication, if you like, is creating a budget, and then the budget you can compare with the actual performance, and that's the key word. So the first report that we produced, this budget variance report, is all about performance. How are we performing against the budget? What's working, what's not? And that effectively it's your scorecard. So you imagine playing any game without taking score or keeping track of score, it becomes pretty chaotic and boring. So if you don't do anything else, make sure you've got the P&L. Next step is having the budget. Next step is having a monthly report, actual against budget, and a year-to-date set of numbers. The second financial report we speak about is the KPI report, key performance indicators, finance. So 6 or 7, sales, expenses, profit, money in the bank at the end of the month, value of work in progress, perhaps. You pick your own KPIs, but we say to people, KPIs are the numbers. If you were lying on a beach somewhere, someone else was running your business, what 6 numbers would you like to see each month to know everything was on track? So in the context of the KPIs, it's trends. So you've got performance, now you've got the trends, and this is where Kate's point about looking forward, you've got to pick up these trends, which getting worse, what's getting better, try and take the lumpiness out of architecture, because it can be really lumpy. You win a job and then you don't win anything for 2 months. The KPIs are how you flatten that out and get trends. Then you've got the forecast, which is we've spoken about at length, the budget, the actual year to date, and then your best guess for the rest of the year, or your best assumptions for the rest of the year. That gives you a forecast. And just bringing that all together, we've got a 4th report, which is simply, what did we originally say we were doing? And what does our forecast now say that we're going to do for the full year? And we compare the two, and we say, look, we're doing well. If we continue in this trajectory, then we're going to beat the budget. Or if we continue in this trajectory, we're going to be 20% less than budget on the profit line. At least now we've got a chance to put that right. Do we increase sales or reduce costs, or do we just accept that our forecast profit is going to be 20% less than what we said it would be? That's maybe okay. It's just a fact of life. But with those 4 financial reports, and it shouldn't take longer than, I don't know, half an hour, 45 minutes every month to put those together, you've got a complete handle And I don't care whether you're architectural business, we have businesses with 50 people, and we've got practices with one person. And we encourage them all to use exactly those same 4 financial reports, because they give you a complete picture of the business in terms of performance, trends, forecast, and comparison with the original budget.
Mm. Yeah, it sounds like a lot, but when you, like you say, Ray, not even 45 minutes, I think you probably update them in 15 or 20 minutes. Once they're set up and they're operational, it's not a labor intense process. And as you become more familiar with them, it's, yeah, you know what you're doing and you can see the value in them and they're easy to update. But they absolutely deal with Kate's point that she mentioned around the lumpiness in terms of, which is often created by invoicing as well, because you have the invoicing lumpiness and the cash flow lumpiness, which doesn't help. But the forecast document is fantastic for sort of ironing things out and having that, kind of full helicopter view of the business and where it's going and what the future looks like.
Yeah, we are running the Fast Track MBA at the moment. It's the second cohort of those folks. So this morning we're speaking about exactly these things in terms of the vision and the budget, not the detailed financial stuff. That's next week. But one of the things that came up was the difference between what we call lead and lag indicators. And this is really important to Kate's point around the future. So if you imagine that your sales are a lag indicator, it's already happened, there's nothing you can do about that. You can detail them all out, and they're really important. But then there are lead indicators, which is the things that gives you some indication of what life is going to be like in 3 months' time, 6 months' time, and a year's time. And a lead indicator would be things like how much work in progress have you got? In our world, work in progress is the uninvoiced portion of all work that you're doing. So you might have 5 jobs, one's finished, one hasn't started, one's almost complete. And if you add up the uninvoiced portion of those, you'll come up with what we call the work in progress number. You record that each month on your financial KPI report or the sales KPI, whichever you prefer. And that then gives you that trend and say, okay, the other one would be what we call the rolling average of work secured. So you just take the last 6 months, add up how much work you've won, divide that by 6 and record that number. And that flattens out your lumpiness. So that's a lead indicator. Record that work secured number every month, 6 months rolling average of work secured. And lots of clients tell us that those 2 numbers, how much work in progress have I got, and what's the 6 month rolling average of work secured, they are the real sleep at night numbers. Because quite often when we're running a business, we do it by feelings. We feel things are going well. Gee, I'm not feeling so good today, and I lost a bit of sleep last night over something or other. You need the numbers to cut through that and give you some real comfort in really where you are. Maybe a terrible position you're in, but it may not be as bad as you think. And you've got to find ways of counteracting that overwhelming feeling that things are not going particularly well. Tim?
Yeah, I think that's well said. The clarity that the numbers provide for people around the business and where they're at, and then the confidence they have to make decisions is can't be underestimated. And we hear it time and time again. People just winging it, just sort of managing all the projects in their head or thinking they understand the finances, but having the numbers on paper and just reviewing them monthly, it's a great discipline and it absolutely improves the performance of the practice.